All right, 1 p.m. Good afternoon, everyone. I'd like to welcome you all to Echelon's virtual U.S. Cannabis Conference as we begin to explore unique, underappreciated opportunities within the U.S. cannabis sector. I'm Andrew Semple, a member of Echelon's equity research team with a sole focus on the cannabis industry. Roughly 12 months ago, Echelon hosted a U.S. cannabis conference that focused on the companies and the catalysts reshaping the U.S. cannabis industry. We welcomed 7 high-quality U.S. cannabis companies who presented their stories, their strategies, and engaged in thoughtful Q&A. Over the following 12 months, the share price performance of these 7 presenting companies averaged 48%, which outperformed the 30% return on the S&P 500. Moreover, if you had invested in our top pick who presented at the time, you would have doubled your investment. This strong outperformance was achieved despite the headwinds we have seen to U.S. cannabis valuations over the past 6 months. We believe the U.S. cannabis industry continues to hold incredible opportunities for investment. As investors have come to better understand the U.S. cannabis industry, we saw an opportunity to focus the theme of this conference on relatively underappreciated U.S. cannabis companies with robust business models and unique strategies. We are thrilled with our group of presenters today. We have assembled a select group of U.S. cannabis companies that we feel offers a true cross-section of the U.S. cannabis industry, while sticking to our theme of underappreciated opportunities. The presenters include some of the largest and best capitalized businesses in the U.S. cannabis sector, but which have yet to receive the full analyst coverage and valuations they deserve. We also have small cap companies successfully growing their businesses with strong cash flow generation, but which may be undeservedly flying under investors' radar. We have companies new to the public markets, as well as companies that were amongst the first US cannabis companies to list on a public exchange. So within a very focused group of presenters, I actually believe there's a broad spectrum of opportunities here for investors to consider. First, I'd like to begin with some details on the format. We'll be hearing from 5 of America's leading cannabis businesses today. At the beginning of each 30-minute time slot, I will provide a brief overview on each company and introduce the presenter. The presenter will then provide a 15-minute corporate overview presentation, followed by a Q&A session. I will be moderating the Q&A session and look forward to having the audience submit questions through the Q&A function on the Zoom chat, as well as on the YouTube live stream. Let's get started. It is my pleasure to introduce the first presenter today, Eric Offenberger, CEO of Vext Science. Vext shares are traded under the ticker symbol VEXT on the Canadian Securities Exchange and VEXTF on the OTC Exchange. We have research coverage on the stock where we have a speculative buy rating and a $2 price target in Canadian dollars. Vext is a leading business in the Arizona market. It produces and distributes vape and branded products, and including concentrates, edibles, and distillate cartridges that are sold in more than 100 of the state's active dispensaries. Its Herbal Wellness Center branded store locations are some of the most productive stores in the state, with ample growth opportunity as Vext continues to lean into the recently approved adult use market opportunity. Finally, the company has partnership structures in several other states, most notably Ohio, where it has achieved distribution of its branded product portfolio to most of the state's dispensaries, as well as where it holds a JV partnership with a retail licensee. With that, I would like to turn the call over to Eric to discuss the business of Vext Science and the growth opportunities in front of it. Eric, over to you.
Thank you, Andrew. Thanks for having us. Vext, trying to get to the deck here. Andrew, I don't see Caroline's deck. There we go. Thank you. So, Vext Science was established in Arizona. We have operated profitably in Arizona since 2016 As Andrew mentioned, we have 2 dispensaries in Arizona. We have the management team. We've been operating in Arizona since 2013 when it first went legal. We have 2 indoor grows, 1 outdoor grow, the manufacturing plant, and we've recently announced that we're going to be expanding our indoor capacity to Eloy. As Andrew mentioned, we have 5 additional states we operate in under a JV model, primarily with Ohio as the focus. We're well capitalized at this point for everything on our growth strategy at this point is done. We have insider ownership of 35.9%. We're going to skip the next slide. So on us, what we think of in the marketplace and how we've identified states that it made sense for us to operate in and be a little deeper was we've always looked at decriminalization as what we think is going to happen. I know there's a lot of conversation about safe banking or where it's going to go. We happen to believe that it'll be safe banking, that it won't be full legalization. With that said, we continue to believe that the focus in Arizona, Ohio, those states with the limited license is the best use of our capital and the best opportunities for our shareholders. Beck Science, oops, went the wrong way, excuse me. Okay, sorry about that. So when we talk about Arizona, as Andrew mentioned, Arizona's got the adult use. I know some of the other panels have operations here too. The Arizona market continues to grow. We anticipate it being $3 billion in 2025, so it's got a long way to go. The other nice thing about Arizona is our medical patient base continues to grow. In addition to, we expect that the tourism season, the snowbirds this year will be a lot greater as COVID is tapered off in Arizona in particular, that we think will have a lot of visitors. The thing we like about Arizona is it's a limited license state. At this point in time, there's 143 dispensaries approved. Part of those are the last group that went out for 12. And what that does to us is it gives us 2.2 per 100,000 for licenses currently contemplated. As we talked, Arizona is a vertical integrated state. So we have cultivation, manufacturing, kitchens. We have the full range. There's going to be an additional 26 licenses that will be issued under social equity. We don't anticipate those to really come into the marketplace until later in 2022, 2023 timeframe. Continuing to work on limited license states. Here we're contrasting why we like the limited license versus like a state like Colorado that's a lot more established. If you look at the dispensary count, it's a lot higher in the state of Colorado to Arizona. We think that provides a better opportunity for us to realize a return on our capital and have a better margin protection that will continue to increase as we keep going forward. It also means that with vertical in the state of Arizona, it's a lot more of a capital upfront cost, and that the ease of entry obviously is controlled by the legislation. Sorry. This is how we've structured Vext within Arizona. Arizona still operates under a not-for-profit model. Because of the Vext with the JVs, the revenue that we generate or show is all based upon what we do in Arizona. So with the not-for-profit model, we have certain levers or abilities to generate income off of Arizona and support the not-for-profit. So you'll see management services, professional services. You won't see the traditional sales to the end customer. As Andrew mentioned, our wholesale business is significant, but again, those sales are reported up underneath the dispensary, which we do not have. We have a management agreement to support. And then what happens is then we do that and the subsidiaries pay back the cash as we incur expenses. This is a picture that shows the existing facilities. One of the opportunities that we have in Arizona is we've been limited to 2,000 square foot dispensaries. In the adult use legislation, Phoenix is allowing us to go to a 5,000 foot. We believe that our existing real estate that we control and own and is on the balance sheet will provide us the opportunity to expand that footprint. The center slide showing the existing dispensary that came in 2013. We own both of those parcels. We're working right now with the city of Phoenix of how to join them and expand them. That's one of the ways we think we can continue to grow and take advantage of a greater customer base. When we look at our canopies and what we've done for the expansion, in Phoenix, we have 11,000 and 9,000 in Prescott, and our total of 20,000. On Prescott, we also have about 10 acres on outdoor. And you can see on the right some of the pictures of the indoor and the outdoor there. When we fully expand by the end of Q4, we'll be at 13,000 in Phoenix, 11,000 in Prescott. And the Eloy facility will be 34,000. It's a 72,000 square foot building. We anticipate having that fully built out by June, July of next year, and fully operational by the third or Q4 where it's producing. Our manufacturing is in the Phoenix complex, and we recently opened up a new facility there where we've expanded our capability, increased our overall space, and improved our operations significantly. That's really allowing us to take and get some equipment efficiencies as the market expands and it becomes a different customer base. We've recently announced ventures with Source for the major brand in Arizona and Wink to bring in the Wink brand into Arizona. Both of them use Source technology and a nano and are highly rated in the beverage category. We think that's going to continue to enhance us and have Vapin brands be fully built out. This is a look at some of the products we're doing in our packaging. This talks a little bit about some of the reasons we've been able to grow, and the brand strength has been very well for us, and that's what's helped us in the other markets for the JVs. If people have recognized the brand and reached out to us in states when they've gotten a license to say, you know, we've got this cannabis license, we really don't know that much about the industry, but we'd like to form a relationship. That's been one of the drivers that's helped us. So our return focus has been always on profitability and what we're returning. We like to look at our cash flow from operations. We think that's in the higher levels within the cannabis space, and we continue to focus on that. We also looked at it from the standpoint of how could we expand without having to have a deep capital and not outrun our human capital. This is a list of how Vapin's currently, or Vext is currently operating in the different states. Financial performance. So far this year, we're at 18.5 through the Q2. We continue, as we mentioned, on the adjusted EBITDA continues to run exceeding where the analysts have predicted it for us. So we continue to perform in the way we'd like. This is a list of the board, and there, that's what I wanted, the share structure. So Vext, like a lot of US companies that are traded in Canada, we have the super voting shares in order to maintain the foreign private issuer status. So once we're fully diluted, it's at 175 million on a fully diluted basis. We talked about insider ownership has about 36% of our shares. We continue to look at different opportunities for the Vext brand where it makes sense on the M&A front. And see how we can continue to grow the portfolio and make sure we're doing the positive operating cash and the return on investment. Highlights, as we mentioned, we think Arizona is going to continue to grow. We've been operating profitably since 2016. We have the 2 dispensaries. We got the 5 additional states. We have the cash on hand to do the build outs we have planned, and we have good control of our shares. With that, I'd like to talk a little bit about Ohio. Ohio is the state that we're focused on in addition to Arizona. We have the retail presence there. We're in process of trying to, we have an appeal that's out with our joint venture for the cultivation. We think will be exciting, and that'll come to fruition for us in the near future. And then we can be vertical. We also know Ohio has the opportunity for expansion of additional licenses coming up. We will be participating in that. We would like to continue to grow in Ohio. We think Ohio and Arizona are going to behave very similar, and that we have know those states well. So that's what we can continue to be the focus. Okay, Andrew, I'm up for questions at this point. I'm sorry about my presentation skills on the slideshow.
No, you did a great job, Eric, going through so much detail so quickly. We really do appreciate that. I'm happy again to kick off Q&A. Just a reminder to our audience, they are able to submit questions through the Q&A function on the Zoom webinar, as well as through the YouTube live stream. So first off, Eric, I wanted to ask on the performance of your stores in Arizona. They've clearly been quite strong relative to the state average, well ahead of peers on a per store basis. I'm just wondering, what were the keys to success there? And do you believe that Vext can replicate that success at the store level as it moves to new states such as Ohio?
Yeah, I think the key, obviously, the number one key is that we've been fortunate with the team that we've built, and the staffing's been done very well. We also, with Arizona being vertical, we also were very cognitive that we had a lot of brands in our store, not just our own brands, but we had that variety for that customer base. And then that said, we recognize the demographics. So our first store is in a very urban setting, heavy medical patient. It's not, it does some adult use, but it's not going to be as significant as the medical, because that patient base does not have the income, and they're not going to want to pay the differential on the sales tax. So we were fortunate with that store that it's always been there. It's a consistent buying base. It's always had a consistent customer base and loyalty. The new store that we moved in July of 2020, that we relocated when we had the opportunity to do the RDF or the organic acquisition, it's located more in an area that has some suburban setting, and we're seeing more adult use there. So I'd like to say by blind chance, we've been able to position our store so that it takes advantage of that. We do think that that's going to translate into other markets such as Ohio, because we've been able to go into the Columbus market, which has the highest patient count within the state, which is Franklin County. And our store is located in an area that's close to the university and has decent traffic, that we believe that that's going to continue to happen. What we're seeing in a lot of the stores is most of the customers are like typical retail customers. They're coming within a 5-mile radius of their store, especially as a market gets more mature like Arizona. You have a lot of stores that are competing. Customers now start to drive to those stores. They don't have to drive like in the early days in 2013, when we were the second dispensary open in Phoenix. If you wanted cannabis, you had to drive. Now that's no longer an option or a necessity for people, and they shop where it's convenient for them.
Great, thank you for that. I also wanted to ask, of all the joint venture opportunities that Vext has and the various, state footprint you're clearly spending a lot of time and focus on the Ohio market. Could you share your thoughts on Ohio and why this state in particular, and what you have on the ground in the state, why this may become increasingly important for Vext as an area of growth over time?
Well, Vext was started, we did things as a bootstrap. So we built the company based upon what we could afford at the time, and we expanded. When we looked at Ohio and got involved with Ohio and our partners there, it continued to look like Arizona. So it had 60 licenses it limited it to. It wasn't vertical, but it had all those elements that made it so that if you made an investment there, you had a chance to get a return on that investment and generate cash flow. When it expands, it'll go to 130 licenses. It's got a population of roughly 12 million. It's got 4 nice metropolitan centers to work off of, so that we keep thinking that it's going to be, we just keep thinking it's going to keep growing. Since we've gotten the retail, we've got the manufacturing, and we are optimistic that the joint venture will receive permission to do a cultivation, which will be the 25,000, the big cultivation. It'll allow us to be vertical there. We are identifying locations to apply for new licenses for the stores. And, we're hopeful that we will receive a couple more retail locations so that we can have that built out and support it. The Vaping brand's been accepted well out in Ohio. There's current common customer base there that we see in Arizona or see in other markets. So it's been consistent. And I think I do think Ohio will go recreational and adult use relatively soon. And hey, how can you pass up 12 million population with 130 stores? It's a great opportunity for us.
Absolutely. Which brings us to my next question here. Looking at Vext, if you had, an additional $15 million appear in your bank account today, how would Vext be looking to spend that, to deploy that capital? Where are the best opportunities in front of it to be able to grow the business?
Well, right now, with Ohio granting the licenses, Ohio only has about 4 licenses that are not already affiliated with somebody that's an MSO. So your opportunities there are limited on acquisition, obviously. Arizona has more. So I would say your best bet would be to deploy the capital into Arizona. You would like to try to find somebody that would fit into your culture, fit into your environment, that you could expand on an M&A front. I don't know if you'd be able to do it with 15 million, but that's where you would look right today.
That's great. Thank you, Eric. I've actually had a question emailed to me, and it was a good one. You've announced 2 recent agreements on the beverage category. We would just like to get your thoughts on what you think of the beverage category, how it fits into your overall plans for the business, and whether you think it's going to become a meaningful contributor to Vext's overall top line within the state of Arizona.
I think it'll be a little bit slow to get started to it, and primarily in Arizona because of the limitation on the square footage that a dispensary has. So one of the advantages we have is we have built out our distribution, and we have an established distribution, so we can do more frequent deliveries. That said, I think beverage will be a niche. I think in an adult use market, it has an opportunity for growth. What we were able to do is shortcut some of the development. A lot of beverage has a problem with the emulsification around the THC, and it separates, makes the consistency or the testing or the dosing not as accurate as you'd want. The other thing it does is it tends to make it more difficult on the flavors. Major is the #1 seller in Washington. It does very well there, moves a lot of units. In other states that Major's been in, it's a similar thing. So they've got a great profile on that flavor. We'll be bringing Major to Ohio also. With Wink, what it does is it's a low calorie seltzer that's a microdose. It is great for a lifestyle thing of recreational, a tourist that wants to have some THC, but doesn't want to have a heavy dose. This is a microdosing. It's got the effect relatively fast, within 20 minutes. It's got onset. So somebody that's wanting to do it in a social setting or use it as a tourist or something along those lines, or take it to a party, you know, to take the edge off, it's a perfect product line for that. What it did for vaping is we call it Vaping Brands. So what it did for the brands is we've got the extracts, the concentrates, the edibles, the infused products. It now gave us a beverage. So one of the things I think is going to happen in the industry is, like any other industry, is you start looking at opportunities to minimize your cost, maximize your return. One of those is to reduce your vendor base. So as vaping's continued to be in the marketplace, we think it helps us with giving somebody a full selection that, you know, one vendor, one invoice, one delivery, and we can help supply your product categories you want to stock. So that's what it did for us, is it completed the brand, and it gave us product that was of the same type of quality that we'd always expected with vaping, that we didn't have to try to develop it in-house to get that proprietary technology.
Great. Also, another question on your production capacity in the state. You know, that having tripled or moving towards tripling by the end of this year. Just want to ask on how you will be allocating that incremental capacity between your own store network and the wholesale market opportunity, and how material of a driver, you know, is the Eloy facility and the expansions you have made at your existing cultivation facilities as well?
Well, the increase in the production capacity gives us obviously two different paths. One, we can do wholesale flower, which we've never done before. We will consume the balance of that, and again, of what Eloy comes up on production, into our own retail spaces. Currently, we buy a lot of wholesale flower in order to meet the demand that our production can't keep up with. But once we bring everything on board, we will have excess and we'll enter into the wholesale market, or ideally, we'll find another independent party that it makes sense for them to be part of Vext, and then we can support that additional retail growth. That's the ideal, but either way, we're well positioned that we can consume it and maintain the margin.
Great, and appreciate how quickly we're getting through all these questions. I think we got time for perhaps one more. And on that, I would like to ask on the transition of licensing. You know, you currently manage the operations of your two Arizona license holders. You know, you guys have stated publicly that you would like to consolidate those businesses by the end of the year. Could you walk through that process and how that could be potentially a catalyst for the stock by year end?
Well, because we are focused on Arizona and that's what we do and what we see, it's a little bit more challenging from an investor standpoint, and particularly I think for a retail investor to really understand the structure and how the levers work that you're pulling the cash out of the not-for-profits, and you know, that structure. So I think when you can go to a for-profit basis of managing them, then it will be easier for the investor to understand the statement, and it'll be easier for them to do a comparison, and they'll understand it better. From Vext standpoint, it obviously reduces the complexity of the situation. So it's a straight business thing on the corporate level. The way the structure will work is, even though the dispensary is not for profit, from a federal income tax standpoint, it's a for-profit organization. So you're really just going to switch the membership owner from the board of directors that's on those dispensaries currently to the ownership of Vext, and it will still file its own separate tax return. But from an accounting standpoint, it'll be considered a consolidated entity at that point in time where Bex has the ownership. It'll give us a lot of other opportunities too, I think, of, again, based upon how we have to pull the levers and stuff for sales. We're normally behind the dispensary in a sales standpoint. It'll make that more transparent. You can do better stuff with your cost structures and stuff.
Right. Well, Eric, thank you so much for joining us here today. Your insights on the Arizona and Ohio markets are really appreciated, and into Vext as well. Again, we continue to cover the company with the speculative buy rating and the $2 price target, and is one of our favorite names in the U.S. cannabis sector. So thank you very much, Eric, for joining us here today.
Thank you, Andrew.
Anytime.
Bye-bye.
Our next presenter with us today is Gary Santo, Chief Executive Officer of Tilt Holdings. Tilt's shares are traded on the NEO exchange under the ticker symbol TILT and on the OTC exchange under the ticker symbol TLLTF. Tilt has a very unique strategy within US cannabis. Through its cannabis segment, Tilt utilizes its production assets in states with limited license regulations to produce its own branded products as well as third-party brands. This uniquely makes Tilt one of the few operators with a white label service in key cannabis markets, offering Tilt growth opportunities and flexibility within its cannabis segment. Moreover, the company also owns Jupiter Research, one of the leading cannabis businesses in cannabis vaporizer hardware design, research, and manufacturing within the US. This segment provides Tilt with broad exposure across much of the US cannabis industry and international markets, where it distributes its vapor technology broadly. With that, I would like to turn the call over to Gary to discuss the business of Tilt Holdings. Gary, over to you.
Great. Thank you, Andrew. And thank you for having me. And I thank all of you who are listening in today for your interest, both not only in Tilt Holdings, but in all the different companies out there, because I do think this is a unique time in the cannabis market space. Certainly the sector has had its ups and downs, rocket ship ups, unbelievable downs. But it feels like the good operators are really starting to separate from the group. And if you just look a little deeper into some of the off the run stories, you start to see there's some real good operations coming along. And I'd like to think that Tilt is one of those. So with that, I'd like to jump into our presentation. Let me just see if I can get this to work. There we go. Okay. This presentation is available on our website, www.tiltholdings.com. So rather than do a complete page flip, I think I'm going to jump to some of the key pages that really drive home the story of who Tilt is. Tilt went public back in 2018, and like many of the cannabis companies that went public around that time, their mandate was fairly broad. There was vertical integration on the plant touching side. There was an idea about technology, software services, distribution, financing, management, and oversight. So pretty much the gambit of everything you could possibly do as a cannabis operator. Not surprisingly, that was too broad of a mandate really for any company to try to do and do well. So over time, we had a very active board that really saw through to where some of the key assets lied and went about the business of reconstituting the management team and refocusing really where the company was going to head. We were lucky that we had accumulated a number of really key assets along the way. I'll talk about some of those. Half of them are on the plant touching side. The other half are on the non-plant touching side. And as we came through sort of a rebirth in 2019 into 2020, certainly as the market was turning around, we really exited 2019 as one of the few cannabis companies at that time who was able to finance its operations out of its cash flow from operations. So we weren't borrowing, we weren't selling things, we weren't diluting our shareholders anymore. The last capital raise this company did was in 2019, and every dollar was spent on refinancing existing debt. So it was about streamlining, it was about bootstrapping. I heard Eric talk about that earlier. It was about getting back to fundamentals and having responsible growth each step of the way. So really what makes Tilt so different is we do operate in multiple states. There's no doubt. We have our plant touching and non-plant touching pieces spread throughout the US, but our focus is not so much on the retail side. We have certain retail licenses in Massachusetts because you have to, but ours is more of a B2B story where we're out there supporting the MSOs, we're supporting the LPs and the cannabis brands pretty much throughout the world. So, whether it's on a bespoke basis where we're doing a custom product for you, whether it's on a white label basis where you're taking one of our products and putting your label on it, or whether it's just coming through with some of our own brands, our job is to try to have a broad range of options and a portfolio of products that allow the MSOs out there to fill the other 30% of their shelves you often hear them talk about. Most of them do support about 70% of their own brand, but they know to keep their customers in-house, they need to have a few more brands other than their own. Our goal is to be able to provide those brands on a partnered basis. Part of the reason for this particular strategy is we believe CPG is coming to this industry. The vertical integration story has certainly worked to this point, and it's been necessary. With the regulatory regimes the way they are, you have to run vertical operations in any state that you're going to be operating in. The issue you tend to have there, however, is the overhead associated. To be in 5 or 10 or 15 different states, you have to run 15 independent businesses, and economies of scale are hard to come by. That said, as we start to look towards the potential for a fully legalized market, we think not only could grow suddenly become commoditized, where mainstream growing is picked up by the big agro shops, but we think retail could also become commoditized. People like to buy online. People like to buy at big box stores. So the need to have all these small independent genius bars, if you will, of dispensaries out there could become a bit of a weight on some of these fully vertical shops that are floating around out there. So for us, we think brands will start to make their way from the West Coast to the East Coast. We've certainly started to see some of that. You've seen Cookies making its foray to the East Coast. We've partnered with Verano Brands. We partnered with 1906, Old Pal, and Her Highness to do the exact same thing, to help them bring the CPG brands that they have from the West Coast to the East. And that's really because it is difficult to scale a brand. You might be a top line brand in California, but what makes you top line there might not necessarily work well on the East Coast, because here in the East, we have limited licenses. We have different regulatory regimes. We have medical markets that are still waiting to go to adult use. So it could be your packaging, could be your formulation, could be your form factor, could be how you actually market the product out there. That all needs to be rethought in terms of how to bring that brand from West to East. Certainly with Old Pal, that's been a great learning experience, I think, for the brand. Our job is to make sure we're experts in the field, in the states that we're in. So Massachusetts, Pennsylvania, Ohio, and soon to be New York, so that this way the brands don't really have to think about it. So what's our value proposition? Really, it's 4 key components. And again, you can split these into plant touching and non-plant touching. So we offer wholesale flower and consumer packaged goods. This is predominantly in the states where we have cannabis operations. So again, Pennsylvania, Massachusetts, Ohio, and soon to be New York. We could offer packaged goods in a number of varieties. Our wholesale flower, we've started to notice, I think, in these states, as more and more grows come online, the sale of bulk flower is starting to fall away and more packaged goods are coming up in place. So the ability to turn that pound of bulk into a bunch of eighth packages, I think, is important, and that's something we do and do well. We also offer hardware and packaging. So again, this goes to our non-plant touching side, the inhalation and the accessories. So that could be the vape power packs, the empty cartridges, packaging not only for the products themselves, but also for cannabis products. So whether it's to put the different cannabis edibles in, to put the flower in. We also offer product development, and this starts to become important in these brand partnerships that we have. So that's where we work across the board, whether it's in our hardware and packaging departments, whether that's at our plant touching departments, to really work with our brand partners to determine what it is they're trying to do, what is critical to their brand, and what is the integrity and fidelity of that brand, and how can we support that, whether it's with our packaging, whether it's with our sales and product development. And I'll talk a little bit more about the types of partnerships we have where really product development is almost as important as the partnership itself. And then the last piece is the contract manufacturing and distribution. And this is something that I think is a little bit of a differentiator. Typical contract manufacturing, you pay a licensing fee, and then you start to produce the product based on a series of SOPs. You're not necessarily responsible for the distribution. You're not necessarily responsible for the sales. That really falls back to the brand that's contracting with you. We offer a turnkey approach. What we allow brands to do is to come into our markets. And in Massachusetts, for example, we sell to north of 50% of the retail outlets, as well as our own stores. In Pennsylvania, it's more like 90% of the retail outlets. So we offer you access to our sales infrastructure so that if you're a brand, you just need to know what you're trying to reach in terms of your brand itself. Are you a high-end premium? Are you a value play? Are you somewhere in the middle? And what is the demographic you're looking to hit? All you'll need at that point are a few brand ambassadors. You can have access to our sales staff as well as our production staff so that with a very low investment on the part of a brand, you can now sell into those 90% of the retail outlets in Pennsylvania and 50% in New York. So when you look at the package together, it's a front to back opportunity for brands, for MSOs to really look at the things they do well, look at the things they'd like to do, but maybe don't have the capacity to do right now, and look at how to spread their footprint out beyond just the four walls of their own organizations. And we offer that on a turnkey basis. The result is really complementary business lines that really speak well to each other. So as you might expect, not every customer who works with us on the inhalation and the packaging side is necessarily a plant touching customer. But over the years, we have had a fair amount of crossover. In fact, we began this year, about 20% of our revenue came from customers who both had the hardware side and the plant touching side. So we'd sell them the hardware from our inhalation department. We would then bring that over into our cannabis operations, fill it, package it, and distribute it for folks. Since we've announced our brand partnership B2B strategy earlier this year, that number has now grown from 20% of our revenue to 30% of our revenue. And that is largely because of the large customer base we're able to reach. On the inhalation side, we are one of 4 distributors of C-cell technology. That is the ceramic coil and heating element that is used in the vaping business. It is by far one of the gold standards out there, one of the largest ones out. We're about 50% of the C-cell market. The other 3 distributors sort of drop off significantly from where we sit. From that, we're able to leverage about 700 different customer relationships. And again, these are MSOs, these are LPs, these are independent brands, and we're able to begin our cross-selling process. So it's a lot of green growth for us on that perspective. Green fields ahead, and we look forward to what we can do from there. In terms of where we are in plant touching, we sort of have a Northeast corridor that we've developed. We're not trying to be all over the country. I think if you look sort of west of the Mississippi, that's a different sort of animal altogether, and a place that we probably wouldn't expect to play in any meaningful size other than with our hardware and our packaging. But we're in Pennsylvania, we're in Massachusetts, Ohio, and soon to be New York. Massachusetts obviously has medical and adult use, continues to be a growing market. I think you're seeing a maturation of that market, more and more flower coming on. There's more access to biomass, which is exciting for us because as we think about how to be as efficient as possible with product and development, especially with these brands coming in, knowing that we can source certain amounts of biomass and then really dedicate our grow to the high-end quality flower is a bonus for us. Similarly, in Pennsylvania, there we don't have retail operations. They are just purely wholesale. It's medical. It's poised to go adult use. It's certainly a market that had a lot of fanfare a year or so ago. It had grown exceptionally large. To get a medical card, you could have any number of conditions. I think one of the limiting factors there has really been the form factors they allow. So you cannot have edibles, you can't have pre-rolls, can't even sell rolling papers, frankly. So as that market begins to expand its demand and starts to think about adult use, I think you're seeing sort of that move away from just pure vapes into premium flower, into other forms, capsules, suppositories, and other items out there. So really, as the form factors start to grow, I think we expect that market to start to pick up steam again. Ohio is one where we have manufacturing. It is a new addition to our portfolio. We took ownership of it earlier this year and doubled its capacity. We now have about 20,000 square feet. We have a kitchen. We have a full processing lab. And there we are just starting to roll out about 4 or 5 SKUs right now. I think that's a market that it's medical only. While it's a little bit more difficult to get your medical card, certainly the form factors are much more robust. So there, the number of SKUs you have are going to be important, and we're excited to bring our brand partners into there. And then New York, obviously, is the one that everyone's been looking towards, with adult use really on the horizon once they get their cannabis commission set up and they can codify some of this. I think everyone's excited for how big New York could be. And I'll talk a little bit more about the unique aspect of that particular arrangement. As I mentioned, here we are. We took a different approach. Again, because we're not focused on retail so much, our concern about having limited retail operations in a certain part of the state was less important to us. We're looking at the potential for wholesale and to be able to reach the entire state. We're also very big proponents of social equity. So through an investor, we were introduced to a group called Connor Green, and they specialize really in working with Native American tribes who have been contemplating doing something in cannabis. And they had been working with the Shinnecock Nation in Eastern Long Island since I think about 2015 or 2016. And they had been methodically developing a cannabis program. While they have their own cannabis commission on the reservation lands, and they could certainly write the code any way they choose to, they've decided to really try to mimic exactly. I don't know why this just changed. Let me go back one. There we go. They wanted to mimic what was going on in New York State. So this way, when the time should come where wholesale is allowed and adult use is allowed, not only would you be able to go onto native grounds to purchase your cannabis, both in adult use and in medical capacity, but we would also be able to sell those products across the border. So it was an exciting opportunity. I think for us, what made it really intriguing was, unlike a lot of MSOs who look at these type of social equity deals, it was important for us that the Shinnecock be the ones who own this facility from the start and throughout the entire process. Typically, when you see MSOs get into these types of things, they'll fund it, they'll finance it, they'll help manage it. And at some point, there's always a path that allows them to take ownership of it. That's not the case here. We're excited to be able to build out a true economic ecosystem that will help give back to that community for years to come. And we will train up the population. We'll do our best to employ as many folks there from the native grounds and train them up into what it means to have a true cannabis operation, not just on the dispensary front, but on cultivation, on manufacturing, on distribution. So we're excited about that. The best part is we're able to get in for very low money. If you look at other deals that are being done out there, people are spending tens of millions of dollars just for the right to try to get into New York and then spend more money, whether it's building out an asset they just purchased from somebody else, whether it's trying to expand their existing footprint. For us, it was about $700,000, about half of which was cash. The remainder was equity. And even if Connor Green hits every single milestone between now and when we commence operations, you're talking about another $2.5 million in equity and only equity. So every dollar we're putting out right now is to build the operation that will generate cash flow. And in terms of what that means to us, we'll be able to receive revenue both from the top line revenue from the day the store opens, about 11.25%. We'll be getting our loan paid back at about a 9% interest rate from cash flow from operations, but then we'll also have about 18.75% call on free cash flow. So it's a very robust amount of cash. The majority of the cash is still going to the nation. That was very important to us. So it checks the box for social equity in a real and meaningful way. It checks the box for a very efficient way to get into a very robust market, and it allows us to really focus on how to bring our brands and brand partners into this particular state and expand the business. I talked about Massachusetts, 100,000 square foot facility, half of which is cultivation. There we have 3 retail stores, one of which has been operating for the last 2 years of medical only. We just recently received our provisional license for adult use and had our final inspection. So we hope to have adult use and medical in our location in Taunton, which is attached to our cultivation facility. We also have a facility a few miles away, again, still south of Boston, in Brockton, that was recently approved for medical and will be opening up in the next few weeks. And just completed its adult use final inspection to go with its provisional license. And we hope to add adult use there later in the year. So medical in the next few weeks, adult use before year end. Finally, we have a medical store in Cambridge. That one right now is awaiting its final inspection to commence operations. Probably don't expect that one to open up until early 2022. In terms of Pennsylvania, I talked about that already. It's a greenhouse operation, high-tech greenhouses there. We sell into about 90% of the dispensaries out there, whether it's MSOs or whether it's independent retail dispensaries. We're agnostic. So we bring pretty much the full gamut of all the things we can offer there. Ohio, as I mentioned earlier, it's manufacturing at this point. I think that's something we could look a little deeper into, as the prior panelists talked about, is how do you grow in Ohio? I think maybe looking to get control of some cultivation might not be a bad idea. But I think at this point, we've been very intentional about how to grow. What's important to us at the end of the day is not to ever become a competitor to our customers. We want to supply them. We want to support them. We don't want to compete with them. So yes, we have our 3 stores in Massachusetts, but it's more than likely that we will share our shelf space more than a typical MSO might to our brand partners and our MSO partners, and really help them expand their reach. Lastly, talk a little bit about our Inhalation Group. So, I think our Jupiter division, Jupiter Research, has been a leader in inhalation. I think one of the things that makes them so unique is their dedication to R&D. They're not just a distributor. They were instrumental in helping bring C-cell technology from the tobacco side into the cannabis side of inhalation. Our founder, Mark Scatterday, was instrumental in that from an entrepreneurial and a design and invention side of things, and worked tirelessly with the factory back in Shenzhen, China, to be able to bring that technology in. And really that's allowed Jupiter to maintain a very important role in that relationship with the owner of the C-cell technology, in that we have co-located R&D facilities. We have people on the ground in Shenzhen, China, providing QA and QC for the R&D teams over in China. Similarly, Smoore has some of its own employees sitting in our Arizona headquarters, sharing our lab space and working collaboratively on joint IP. We're also the only distributor in the US who does the warranty claim work and tech support. So, we are there to provide more than just a vessel through which someone can buy our different C-cell products. You might be familiar with Curaleaf Select. If you look at C-cell products, it's a Jupiter cartridge, Jupiter battery that powers that. Obviously, they fill it with their own oil. And we continue to see that most of the MSOs, when they're putting out their flagship brands, such as Select, they do tend to look to C-cell. It is a bit more expensive. It's the premium brand out there. But when they're putting their name on that, on their premium side, they want to make sure they've got the Cadillac, really, of vape hardware. And then, of course, I talked about the innovation and the full lab that we have in Arizona. In terms of where we are financially, as I mentioned earlier, we are fully funded out of cash flow from operations. I think we were very methodical over time with how the business was rebuilt. Certainly, as we came out of the vape crisis in 2019 into the respiratory pandemic of 2020, if you looked, you would see our revenue growth from 2019 to 2020 was really relatively flat. But if you looked at our EBITDA growth, we went from being negative 1 million EBITDA to positive almost 17 million EBITDA. And that was really all about right sizing the business and really focusing on the core businesses that were driving potential growth. As we look ahead, the nice part about the investments that were made prior to this year is that it allowed us to have fully built out operations. So all of our retail stores are fully built. They're just waiting for the licenses. Our cultivation and manufacturing, while they do require some maintenance CapEx, we're talking in the hundreds of thousands of dollars, not tens of millions, because again, they're fully built out. So, you're talking about upgrading a machine or upgrading a lighting system, not having to add an actual capacity. The only real meaningful CapEx facing us will be what we do in New York as we spend the time and the money to build out the operation there. We'll design it, we'll control the build out. But really for 2021 and into 2022, our existing assets are poised to give us some significant growth. So again, this is the dynamic I was talking about earlier from 2019 to 2020. You can see the kind of growth we had on the EBITDA side and the cash from operating activities. As we look forward to accessing the capital markets, I think what you'll see there is a very opportunistic approach. Earlier this year, we were able to launch an ABL, an asset-backed line, supported by our non-cannabis inventories. I think that was a very important $10 million line. It came through at prime plus 3.5%. It's very favorable rates. We do have a little bit of debt on our balance sheet that we will be looking to refinance at some point. Again, being opportunistic, none of it comes due until the earliest 2022. So we think we have some opportunities there to look at what the market's giving right now, because the debt markets are pretty robust. So in summary, what we offer is a unique multi-state international operator focused on B2B. We give you plant touching assets and non-plant touching assets. So it's a nice hedge, very slow and steady growth on the inhalation side, explosive growth with high margins on the plant touching side. Our ability to internally fund growth and be opportunistic about accessing the capital markets, and tremendous opportunity for expansion in the multiple markets. With that, I will open up the remaining time to Q&A. Again, you can find this presentation on our website, www.tiltholdings.com.
Great. Thank you very much, Gary, and an excellent overview of the business. My first question is on the white label side of the cannabis operation. How do you manage that potential conflict of interest of having your own brands in the marketplace, alongside some of the white label products that you offer? Like how do you manage, which brands you market, which brands you put on your own store shelves? How does that play into your decision making?
Sure. So we've developed a grid that kind of looks at the various levels of price points and quality points, and then how many different form factors can you really have? And of course, that is informed by what's allowable in each of the sections. Our goal with our home house brand, which is Standard Farms, is really to have that fill in the gaps wherever our brand partners, our MSO partners are not able to touch. So as a lot of these MSOs are using, their grow space for premium flower to sell premium flower, when it comes to capsules or things like that in Pennsylvania, for example, we're happy to step in and offer that either on a white label basis. It could be a Standard Farms branded basis, or if we're bringing in a third party brand. So again, our brand is there to support and fill in gaps. We're not trying to make Standard Farms a preeminent brand because frankly, that's an expensive proposition. And to do that in scale and nationwide is very difficult. I think I talked about that Northeast corridor. I love having all of our operations within a few hundred miles of each other, so we can start to have some centralized heads of cultivation and heads of cannabis operations. So even though I can't cross state lines just yet, when that time comes, everything's in one spot. So when we bring our brands in, we make sure they fill a spot on that grid. And frankly, it's a spot that's either underserved, that we know there's tremendous demand for, or really as these markets mature and you see price competition, especially on the wholesale side, if these are brands that successfully were able to hold their position in California, where it's clearly super competitive race to the bottom, then that type of architecture coming east are probably giving us access to retail price points that we couldn't touch on our own, and our brand partners and our MSO partners probably couldn't touch on their own. So a higher starting point, even though we're sharing some of the economics, still yields, I think, what is a very consistent and sustainable business model.
Great. And now we have a question from the audience that I'm going to merge into one of my own questions here. I want to look at the New York marketplace, and my question is, how large is the New York adult use market opportunity? Potentially several years out, and how will Tilt through the partnership agreement you have there be able to capitalize on the wholesale opportunities within that state?
Sure. So just yesterday, Shinnecock announced that they had a vote and they approved adult use on their native grounds. So if that was a functioning dispensary right now, if everything was built out the way we anticipate building out in the next 12 to 18 months, we would be the only entity selling not only medical, but adult use really in the state of New York. And people can come onto the native grounds and they can leave with product. Obviously, there are certain regulations around that. Our longer term view, though, is that at some point wholesale will be permitted. In fact, the state has been very vocal about wanting a dispensary built on Shinnecock lands and being able to wholesale third party product in there. So our government affairs folks are working hard together with New York State to try to figure out what will that wholesale look like. When will that code be written, so that this way we can start to sell out off of the reservation lands throughout New York State. Certainly, we saw what we've done in Pennsylvania, where we touched 90%. We saw what we did in Massachusetts, where we touched 50%. I have no doubt that if once adult use is up and running in New York State, it'll be every bit as robust as Massachusetts. People are saying it's going to be the next biggest market next to California. I think there's tremendous ramp and runway there. So that's really why we did this. When we ran the numbers, frankly, it still looks very attractive, even if all we ever do is sell out of that one dispensary or even add a second dispensary on Shinnecock grounds. But if we can open up those doors and be able to wholesale product to the broader market throughout New York State, that's really where things start to become a lot more fun.
Thank you for your insights there. I think we have time for one more question here. And I do want to touch on the inhalation business as well.
Yep.
Within that segment, what do you see as the most important growth drivers for that segment? Is it through R&D? Is it through new product launches? Or is it through, monetizing and better penetrating the existing market opportunity?
I think there's two pieces. I mean, it's been a very steady business. I think we're happy to see a return to sort of pre-COVID levels for purchasing. And some of that's been just by form factor, in the sense that, I think all-in-one disposables were something that fell by the wayside when vaping started to contract a little bit last year, because the convenience wasn't necessary. Tourism was down in most of the states where the all-in-ones were most popular. You certainly didn't need that utility if you were working from home, and you tended to see people migrate towards smokable flower away from the vapes. But now they seem to have come back, and we've seen a huge pickup in those all-in-ones. I think R&D and innovation are going to be key, because the other piece we've noticed is, I think the existing concentrates and the flavors where you've seen sort of the peach mangoes and things like that. There's still a place for that, but people are moving more towards the natural terpenes. They want a more authentic look and a feel and a taste. So you're seeing the live resins, you're seeing the rosins, the waxes, the shatters, all starting to come into the vaping space. And that's going to require a different sort of device, I think, that will allow you to really get that as close to a plant flavor profile as you can possibly get, while still having some type of a concentrate as opposed to pure smoking the pure flower. I think there's also an opportunity for heat not burn. I think that's one of those holy grails out there. Can you do it? Can you do it well? Because there are just certain things that combustion provides to the flower that just heating it, may or may not be able to do. So we're excited to work collaboratively with the factory. I also think the other piece is looking at the fact that a lot of these MSOs are developing two different lines. They have their high-end line, their premium line, and they're definitely going down the path of C-cell. I think you're seeing, they're tending to have more inexpensive lines out there for the everyday person and user, and the ability to really create products that will fulfill that gap. We've seen some of the other distributors on the C-cell side start to carry those other types of products. I think we could start doing more R&D and carrying those products as well.
Great. Thank you so much, Gary, for joining us today. As always, you've got excellent insights both on the business and on the overall industry as well. So appreciate you taking the time to share your thoughts on Tilt and the U.S. cannabis industry today. Thank you.
Thank you so much, Andrew.
Great. I am pleased now to introduce our next presenter, George Arcos, Chief Executive Officer of Verano Holdings. Verano shares are traded on the CSE exchange with the ticker symbol VRNO and on the OTC exchange with the ticker symbol VRNOF. We have research coverage on the stock where we have a buy rating with a $40 per share Canadian price target. Verano is a very sizable US cannabis company. The company is active in 11 US states today, operates over 85 store locations, and has over 840,000 square feet of cannabis production facility space. In addition, it is projected to exit the year at a $1.1 billion revenue run rate. And based on consensus estimates, it is expected to produce the third highest Ebitda in the entire cannabis sector for 2021. Core markets include Illinois, Florida, Arizona, New Jersey, Pennsylvania, and Ohio, amongst others. Each of these are some of the most attractive limited license markets within the US. The company has been very active with M&A since becoming publicly traded earlier this year, deploying over $700 million in highly accretive acquisitions, with many of the targets being some of the best performing assets in their respective states. With that, I'd love to turn the call over to George to walk us through the business of Verano and the growth opportunities ahead. So George, over to you.
Good afternoon, Andrew. How are you today? I have Aaron Miles with me here as well.
Hey, Andrew.
Great. Hi, Aaron.
All right, where would you like to begin? Want to go through the presentation and then open up to a little bit of Q&A?
That would be perfect.
All right, great. So I'm George, the founder and CEO of Verano. With me, Aaron Miles, our Chief Investment Officer. We are a multi-state operator with operations in 11 states and licenses in 14. We currently employ about a little over 3,000 people. We have 85 open active dispensaries. We have 4 brands that we work with, Verano, Move, Avexia, and Encore Edibles. We started off this business being a large wholesaler in our home state of Illinois. We began our journey in 2014. We have been and continue to be one of the top 3 wholesalers here in the state. We've been a company that's been very successful in organic license wins throughout the country. Today, we currently have what I feel is one of the best operational platforms throughout the US. We went public this year in February. Since then, we've announced 11 acquisitions, 10 of which have closed, all great assets in multiple states. We had a very strategic M&A strategy when we came out. We really wanted to concentrate on Pennsylvania, Arizona, and some tuck-in acquisitions in Illinois and Ohio to really fill out our footprint. As we move forward, we will continue to find great acquisitions that fit the culture profile of Verano, and we're really excited about the future. I'll run you through some of our core states and where we've begun. Illinois being first and foremost, we have over 200,000 square feet of cultivation here. We have 10 active open dispensaries. most of which are located in municipalities that have either put restrictions in place for X amount of stores or in areas that are very difficult to get into. So we have very good, strong protective moats around those stores. Again, we're one of the top 3 wholesalers in the state and continue to be. We're very excited about the new licenses coming out in Illinois. These dispensaries should start opening hopefully sometime next year after litigation is over, which we would hope should be very soon. Florida being our next largest market through the AltMed acquisition. We currently have 37 stores open in Florida. We love the Florida market. We believe that it's poised for an adult use transition over the next couple of years. We believe it'll be one of the strongest markets in the country, and we continue to press forward very aggressively in that state. We're about to start our second large-scale indoor cultivation facility, and we continue to open up retail stores. We should open 3 or 4 more stores this year, and we'll continue an aggressive approach on the retail side next year as we scale the next cultivation facility. Arizona is another large market for us. We entered that market through the AltMed acquisition, and then we added on the territory team, which gave us 3 very strong stores, again, in municipalities that have caps on their current retail stores. So it gives us, again, a very strong moat, and another 2 stores in Phoenix being Local Joint and Emerald. We're about to rebrand all of those stores to ZenLeaf and make a large push as well on the wholesale side in that state. It's been very strong adult use transition there, and we're excited about it. You might see some additional acquisitions from us in the future in that state on the retail side as we continue to expand our cultivation capacity. New Jersey, legacy for Verano, another organic.
George.
Yes.
So sorry if I interrupt you. If you'd like, you do have control of the slide deck if you want to flip to where you want to be.
We didn't see the controls here, Andrew.
Yeah. Is it working?
There we go.
Got it. There you go.
There we go.
Okay, so New Jersey, legacy market for us. We have a very large scale indoor cultivation facility there, which we're excited about. We went ahead and moved forward with construction there when we thought adult use was coming, so we're ready for that market. We have 3 open dispensaries, 1 in Elizabeth, which is close to the New York border, 1 in Neptune Township, which is in the Jersey Shore, and 1 in Lawrence Township, which is close to the Pennsylvania border, also by the Princeton University and Quaker Bridge Mall. So great locations. We're very excited about the adult use transition. We thought it was going to come in August. Instead, they dropped the rules, but it looks like by February, we should be transitioning over to AU, possibly sooner if the regulators allow us to make that transition. We feel, again, it will be one of the strongest markets in the country. Small amount of operators there, big population, and with all the traffic between PA and New York, I think we're poised for very strong growth out of New Jersey. Next would be Pennsylvania, a market where we currently have 12 stores open. We had quite a few acquisitions there. We had the Healing Center, we had Terra Vita, Agrikind, and Agronomed. Vertical integration came for us in July. We're also starting construction soon on a second large-scale cultivation facility, which will prepare us for adult use, which we also feel will be coming there in the next couple of years. So that'll give us time to get ahead. We should have an additional 6 stores open, hopefully by this time next year. We have currently stores under construction, others going through zoning, all in high population areas, flagship locations. So we're very excited about our Pennsylvania footprint. We think our retail stores are some of the strongest in the state. We have a great team there in place, and that we feel that PA is poised for tremendous growth for Verano. Ohio is the next market. We have 5 operating dispensaries there. We also have a 22,000 foot facility, which recently underwent expansion. And we're positioning to the state to start another round of expansion there, hopefully next year, which we're excited about. I think Ohio is another market that's poised for adult use transition in the next couple of years. We recently announced the next round of licenses for dispensaries in order to be ready for that transition. Nevada is another legacy market for Verano. We currently have announced an acquisition in Sierra Well, which we hope to close in Q4. We have another store, our 3rd store, which will open up hopefully sometime next month. We're waiting for the state to come and inspect. We just recently completed construction, so that'll give us 5 stores in the state upon completion of the Sierra Well transition. And we have a cultivation facility there that's undergoing expansion, which will also be done by mid-October. We should be putting plants in the building in Q4, which will give us much more needed cultivation capacity in that state. Along with the Sierra Well transaction, we have an additional 10,000 foot facility, which we'll be making some changes to, which will bring it more to Verano-esque style of a facility, which we're excited about. Maryland, another legacy market for Verano. We have 4 operating medical dispensaries, which is a maximum amount. We have a 38,000-foot multi-tier facility, which also just recently underwent an expansion and is now complete. So we're looking forward to that additional cultivation capacity coming online towards the end of this year. And we're excited about that market. We think that's another market that can make an AU transition, hopefully within the next 18 to 24 months. They're discussing that currently. We have close to 6 million people there as well. It should be a very strong market for us. Massachusetts has been a tremendous adult use market. Our cultivation facility just got approved there, a little bit behind schedule on the regulatory side, but we're excited about it. It's a ground up construction, state-of-the-art facility. We have 2 stores currently open in Sharon and Plymouth. The Sharon store is right by the Patriot Stadium. Does very well. Plymouth is on the shore, also a very strong store. We're actively looking for a 3rd strong store throughout that state. And we're looking forward to adding wholesale capacity as well as getting our vertical integration going. Michigan, small footprint for us. We have 1 operating dispensary in the southwest portion of the state. Does very well. We might be adding additional retail and or cultivation in the future, but for right now, it's more of a wait and see approach on Michigan. And then Arkansas, we have 1 operating dispensary in El Dorado. Does very well. Might be another market where we add additional either retail and or wholesale capacity, but for right now, again, wait and see. We're currently building out West Virginia. We want a cultivation, processing, and 7 dispensaries there. Everything under construction and should be coming online towards end of the year, Q1 of next year. California, we have a partnership in place on the production side. In Missouri, we have a manufacturing license that we won. So that takes care of our footprint. From there, we can move on to skip this here. I talked a little bit of our acquisitions. To get a little bit more in depth, through Altman, we gained what I feel is one of the best teams in the industry. Very similar to Verano. The founders built that business in a very sound, professional manner. Again, no sale leasebacks. They built a strong operational platform. They had positive cash flow when we met them. They've done a tremendous job in that state. They've been one of the top groups in that state since day of inception, and that they continue to be incremental to our growth and instrumental to everything that we're doing across the country. They really have a solid team that's blended very well with ours, and integration has gone very well. The territory team and AZ, all of the founders of all 3 of them have stayed on board as well. They've really taken a strong approach to that market. They have so much knowledge about it. They've been there for quite some time. So we continue to use them. The THC team in Illinois is a team that we know very well. Founders have also stayed on board there and helping with our Illinois expansion. Mad River Remedies was a great store in Dayton, Ohio. That was a takeover for us, very strong by the university. And that store has done very well. Integration has also, again, gone very well there. Sierra Well is a transaction in Nevada, and we look forward to closing hopefully here in Q4, which will give us access to both Reno and Carson City, which we were not in, as well as an additional 10,000 square foot cultivation building, which we need. And then NSC is a license in PA. We just opened up our first store of those 3. The other 2 stores should be opening up throughout Q4 and Q1 of next year. Terra Vita, one of the strongest retail footprints in Philadelphia region. 3 very strong stores doing extremely well for us. And we're obviously very excited for our PA footprint. The Healing Center was the 3 strongest stores in the Pittsburgh region, also doing very well. Founders have stayed on board. They're helping with the growth in that region. We just opened up another store in Robinson Township, and we have an additional 2 stores opening up in that area. Great team, great people. We're very excited about that. Emerald Dispensary was a standalone Phoenix dispensary. That was a takeover. Team is integrated very well with the territory team and the move team in that state. Local joint, same thing, takeover. Territory has taken that over for us, and we're looking forward to transitioning those stores all to Zenleaf and really pushing the Verano Brands, as well as Encore, Move, and some of the territory brands in that state on the wholesale side. Agrikind gave us vertical integration. It was a 60,000 square foot facility in the Philadelphia region, so unlocked vertical capacity for us. We're currently making some transition and some changes in that facility to make it again more Verano-esque, bringing in our strain profiles, changing the growing methods a little bit, but the facility was first class, state of the art. That's why we chose it. And we have, with the Agronomed transaction, we're building a 2nd cultivation facility for us, ground up, which will be exactly the way that we build our cultivation facilities.
And I'd say something to highlight here too, and George touched on this, is these are partnerships for us. We definitely want to integrate with the teams that, we're acquiring, and we look at them more as partnerships. And, the biggest thing that we can highlight here is this wasn't a land grab for us. This was all very strategic and deliberate on our part to build out our portfolio, especially in light of markets that are transitioning over to adult use. So George gave you the run through of our footprint, but, we really feel that we're positioned well in those markets that, are primed to transition over to adult use.
On to our brands. So Verano is our flagship brand. That's really where we put all of our flower, which is what we're known for, our pre-rolls, concentrates, and vape cartridges. We're introducing the Verano Brands in Pennsylvania, Florida, and Arizona here in the coming months. Encore is our edible brand, which is also undergoing a refresh right now. And we'll be introducing a second edibles line, more millennial focus here in the next few months. Avexia is more the medicinal line. We do a lot of microdosing there, tinctures, balms, salts, etc. It's done very well for us in medical markets. And then the Move brand, which came with the AltMed transaction. A lot of R&D behind that brand, inhalers, patches, some really unique products that we'll be deploying throughout the US. And that's what we're currently focused on right now from a brand perspective. Here's a picture of some of our retail stores, very high-end look, white oak, nice floors, great lighting. It's meant to be an inviting atmosphere, something we're very proud of. And we're currently undergoing some changes in our Florida stores and Move to make them look more like our Zenly brand.
And this is where George's background in, hospitality is really key to, the brand that we're developing from a retail perspective is, the look and feel of the stores is just as important as the product that you put on the shelf. So, we're very intently focused on making sure that every customer experience coming into our store is up to our standards, because the last visit is going to be what you judge us on. So we definitely make sure from our perspective that we're nurturing our brands.
Absolutely. So things here. Going through the last quarter, 199 million in revenue, 100 million in gross profit. 164% growth versus 2Q 2020, and we're looking forward to strong growth here in the future. We had 4 million of free cash flow last quarter, 285 million in working capital, 150 million in cash, 572 million in current assets, and 287 in current liabilities.
The free cash flow, and this is something that we want to point out here, is when you can generate solid or positive free cash flow, and George walks you through all of the expansion efforts that we have, the 7 cultivation expansions. We're building out something in Massachusetts. We've had a luxury of being able to self-fund CapEx while still generating, positive cash flow. And as investors, you're going to want us to run that free cash flow number as close to zero as we can, because that means that we're reinvesting back in the capacity that we can bring into the market. So, the blueprint that George was able to layer on top of this business from the inception is what kind of set us apart, being profitable really since day one, leveraging cash flow and reinvesting that back into the business. So the amount of free cash flow that we have is produced in a quarter is by design, because that, again, it's going to go all right back into the business to enhance our operations.
Yeah, we're undergoing aggressive expansion of many of our cultivation facilities, retail stores throughout the US. And so for us, it's important to maintain that cash flow to be able to continuously put pressure and pedal to the metal in our CapEx, and we want to be able to fund that internally. That's always been our story for the last 7 years, and we're continuing down that path. We're very, very bottom line focused, and that's what we're known for. Margins will continue to get better throughout the year as we streamline all the acquisitions that we made, and we're very much so looking forward to next year. We have strong plans underway for continued growth throughout the next couple of years, and these projects are all coming to fruition quickly. Like we said earlier, 7 cultivation center expansions currently underway. 1 full build out in Mass, which is complete. Retail stores throughout the US under construction and coming online, and New Jersey adult use, which is going to add strong growth for the company. We plan to exit the year at a $1.1 billion annual run rate, and our Ebitda margins will continue to grow throughout the rest of the year. With that, I'd like to turn it over to you, Andrew, for any questions that you have or the group may have.
Great, and thank you so much for your presentation. Great overview of the business. The first question I have here is on the M&A, and something that Verano has been very active on year to date. Could you provide some high-level commentary on how you came to decide on those specific transactions, maybe what sort of M&A criteria you employed? And could you give us a sense on what M&A opportunities might still lie ahead in Verano's future?
Sure. So for us, we're constantly looking for the best entrepreneurs in every state that we're looking at M&A targets in, right? So we're looking for similar individuals like us who have built similar businesses, profitable, have great real estate. If it's on the cultivation side, we want to make sure that the facility has been built out in a way where we can continue to grow at the high quality level that we do. On the retail side, we're looking for best in class assets. It's population, it's site location, and again, how they build their business, right? For us, it's all people, process, product. We're looking for the best people. We're looking for an efficient process and high quality product. From there, it has to also fall in with a certain Ebitda profile to make sure it's accretive to Verano. And that's how we pick our transactions. Again, it's a very strategic focus for us. We look at what market do we want to be in. We then look at that market, who are the best players, and that's what we go for. And vice versa, people who are looking to get acquired or bolt onto someone also tend to reach out to us at Verano because they're looking for a strong company that's long-term focused with long-term viability, which is how we've built our entire platform and our business.
Great color, thank you. I also wanted to talk about Verano and the way it's managed its balance sheet. Very underlevered relative to your peer group. You own all your assets. You haven't pursued sale leaseback transactions. Relatively lower amount of debt outstanding. I just want to ask on how you view the business's ability to add leverage over time to potentially capitalize on opportunities that might arise, either investing more heavily in the states where you already are, or moving into new states through M&A.
Great question. So today we're not in need of any cash. We have a very strong balance sheet. Our cash flow takes care of all of our CapEx and our future projects. That being said, if there's a great M&A target, we have optionality on the debt side. Rates continue to come down for a company like ours that owns all of its majority of its assets. We do have great optionality on the debt side, and you could see us print something in the future as we continue to transact on the M&A side. So it's a nice position to be in, and we're very proud of what we've done here. Again, long-term viability, long-term approach to everything. Not that sale leasebacks are a terrible thing, but the rates over the past 7 years were quite high, and we felt that it wasn't good for a long-term approach for our company. We made it through those times. Again, that's why we're very bottom line focused, make sure that we had enough cash flow to cover all of our construction. We're not slowing down in any way, shape, or form on the growth of the company. And we like where we're at today.
And I'll say this just to add on to that, Andrew, we are very underlevered, and that's by design. We've could have ripped, hundreds of millions of dollars through, sale leasebacks or, multiple credit facilities. But, we have a history of taking what we need and then investing ahead of market growth. So I think, being good stewards of capital is definitely a signature of Verano. We're always going to be focused on, the next best credit facility, always improving on the terms that we had prior, and also really focusing in on dilution of the stock. We want to be very careful on how we, go forward from an equity perspective as well.
That's great color. When I look at Verano's portfolio today, you're very deep in many of your core markets. Often where there's caps on licensing, you're at or near those caps. When you look at the business, 2 or 3 years from now, I think maybe that entering new markets offers a great lever for growing the business. Where do you see the opportunities, or which states do you think offer the best opportunities for Verano to expand into over the coming years?
That's a good question. If you say today, there are multiple markets in the Northeast, in the Southeast, there's some opportunities still for us out West, but that'll change in the next 2 to 3 years. Additional markets will continue to come online, both medical and adult use. So for us, we look at every market. Eventually, we want to be in almost every limited license market if it makes sense for Verano and our shareholders. It doesn't mean we'll be in every state in the country. Some states might not make sense for us, but we'll continue to look at every market, and if it fits our profile, we'll transact, or hopefully we'll have an organic license win, and we'll continue to grow the company strategically.
Great, thank you, George. Something perhaps a little bit more topical. There was some news out this morning on the Safe Banking Act, again, passing the House of Representatives. I do want to ask on how Verano continues to monitor the status of federal regulations and how you plan for that within your business. And maybe if you could comment on some of the potential impacts that the Safe Banking Act would have on Verano itself.
Yeah, sure. Go ahead, Andrew. Yeah, I can lead and I'll let Aaron recap on safe banking. For us as business, we don't need federal legalization or safe banking to continue to operate, and more importantly, to continue to grow and be successful. We really look at this business within the current regulatory framework, and we ensure that we're successful no matter what happens on the federal level. That being said, safe banking would be great. We need something. It would be great for us to have better access to debt, have access to big banks, have access to U.S. exchanges, all major positives for the industry and for Verano as well. We'll see what happens. It's a positive incremental step. I think safe banking is something that could and should happen at the federal level. That being said, we'll see. It's something we've been talking about for quite some time, and we hope to see something soon.
Yeah, no, I think that's, obviously where our focus is at is making sure that we maximize the opportunities that are ahead of us. I mean, even if we take an incremental step in the safe banking where we just have access to federal banking and credit cards, that would be a step in the right direction for our business. We're aligning things that we're doing is, conversion over to IFRS. We just recently registered our 20F. So we're preparing for the US market and having the conversations that we need to have. So talking to the major exchanges, making sure that we're going to get up to the finish line and be ready to go and not caught flat-footed when opportunities present themselves. Another key component to the Safe Banking Act is, the social equity reform of the cannabis industry in general is a heavy focus, as it should be. And, you're going to have new operators coming into the space. And really to start out, and I don't want to make George cry here with how he's had to operate from inception to date, but you're going to want to level the playing field and give them access to banking and credit facilities to really grow their businesses. So I think you're going to see these kind of mesh together going forward. But we'll be ready if and when those opportunities present themselves.
Great, thank you very much for your insights there. I do have a question from the audience asking on recent insider buying and purchases being made there. Could we get an update on how much of the business management owns and your continued confidence in the business, particularly in the back half of the year and in the context of kind of the share market, share price pressure we've seen in the first half?
Sure. There was a little bit of insider buying from myself, Aaron, Darren, our general counsel, Brian Ward, CFO. Obviously just shows the strength of what we believe in Verano. I mean, again, everything we've done here the past 7 years is for long-term viability and long-term growth. So we believe it's a great buying opportunity currently, and we continue to feel that way. I am the largest shareholder of the company, roughly 18% of the company, and I'm obviously very aligned with our shareholders. So for us, it was an easy opportunity to buy, and we'll continue to when and if it makes sense for us. But we are focused on the growth of this company and its future. That I can say with wholehearted confidence.
Yeah, I mean, we can put messaging out there and talk about how much we believe in the business, and we can, we've obviously evaluated different avenues that we could take to show that support. But when you're investing your own dollars, it's not just a signal to the market we support, the company. As George mentioned, we believe in the story. I mean, our lives are invested in this business, and we'll continue to show that to the market. George, as you mentioned, is bulk majority. Management overall owns around 23% of the business. So there's still a healthy amount invested in really what we see as a very strong potential going forward. Yeah.
Very helpful. Thank you both. We have time for perhaps one more question here. So I would like to ask on something that came out earlier this year with your Q1 results. Reported a very, very strong Ebitda margin, adjusted Ebitda margin north of 50%. I believe that's the highest print we've seen in the US cannabis industry. Could you comment on how you're able to achieve such impressive profitability levels within US cannabis, and what the outlook is for margins going forward over the coming years?
There's not a specific recipe there. It really goes back to the three fundamentals, right? People, process, product. You have to have great people across the board, which is not easy. I've been very fortunate to be able to bring some strong individuals from my hospitality industry and other ventures that I've been in that I really lean on to continue to grow the company. We've also, again, with the Marymed acquisition, got, again, one of the best operational teams in the industry. So I can't say enough about our people. Without great people, you can't have great margins, great product, great business. We spent also a lot of time on the process. A lot of R&D the past 7 years on the cultivation side, processing side, making everything very efficient, and a high quality product at a high price point, which is what we're known for. And you put those three things together and you get this margin profile, which we've been showing off this past year. But for us, it's a constant push, right? We're not perfect. We are constantly on that pursuit of perfection. We try and be better each and every single day. We're never happy with what we've done. We just continue to look to get better throughout the next few years. And I think we will.
And I'll say this too. I mean, we're hyper focused on expense management. Investments in SG&A, investments in other areas of the business. Some in our space have really tried to build a business for 5 to 10 years out, and we will obviously get there as the trajectory of the business grows. But George has done a fantastic job at really setting the benchmark for us to invest, again, ahead of market growth. So you see what we're doing just from an expansion of our operations perspective, but we're doing that with headcount and other areas of the business that we're investing in to make sure that we are ready to capitalize on market opportunities that are ahead of us. Going forward, Q1 was a tremendously strong quarter from a margin perspective. Q2, as we had talked about on our call, had a little bit of accounting noise, but nothing that is sustainable across the board. And then going through the course of the year, we anticipate getting back to our historical margin profile, which really, kind of nets out to mid to upper 40s on the adjusted EBITDA perspective. And then, again, gross profit margins, historically as an industry leading profile.
Great. Well, thank you both very much, George and Aaron, for joining us today. We very much appreciate your insights into the U.S. cannabis industry and on Verano itself. One of the most expansive and deepest portfolios of U.S. cannabis assets within the sector. So we thank you for your insights and look forward to continued coverage.
Thank you, Andrew. Thank you, everyone. Have a great day.
Thank you.
Great. Our next presenter for today is Bob Fireman, Chief Executive Officer of Marymed Inc. Marymed shares are traded under the ticker symbol MRMD on the OTC exchange in the US. The company is one of the earliest US cannabis companies to list on the public markets. It has undergone a transformative strategic plan that included consolidating full ownership of its underlying managed entities, growing revenue in existing states, expanding to new markets, and solidifying the brand portfolio. The strategic plan resulted in strong revenue and profitability growth for Marymed shareholders in 2021 and 2020 as well. Marymed continues to demonstrate operational expertise with its growing portfolio of wholesale and retail businesses and expanding pipeline of M&A opportunities. With that, I would like to turn the call over to Bob to walk us through the opportunities ahead at Marymed. Bob, over to you.
Andrew, thank you. And on behalf of all of us at Marymed, thank you to Echelon for the opportunity of speaking at your conference and bringing our message and story to the public. I'm having a, there we go. Okay. Hey, first of all, I am not geeky, so running this PowerPoint is going to be good. So I have a larger, lot of group of slides here, so I'm going to fly through it because I really want to talk for only 20 minutes and leave 10 minutes for questioning. So, I always start talking about the mission. I mean, Marymed has been around quite some time, but we've always shared our values and our culture to provide meaningful, positive change for the lives of millions of our customers through our products, our actions, and our values. It's not always about the money. I think until you walk into a dispensary and see the relief that we give to mothers with epileptic children, people with anxiety, nausea, MS, Parkinson. It really brings home why we got into this industry, and it's important that we remember where we came from. So Marymed, as Andrew said, we're a publicly traded MSO under the symbol MRMD. We have developed licenses, won licenses, and developed cannabis businesses in many of the most robust, attractive markets. We're known for our validated management experience. Our team's been together over 10 years, and we've learned a lot. We've learned how to develop the best practices in cultivation, production, retail, delivery. We've developed the top proprietary brands that are top sellers in each market. And most of all, we moved from being consultants to full-state MSO. We're now profitable, financially strong, and poised for growth. I think the management has done this through being very disciplined from a financial leadership standpoint. We believe in bottom line, and we believe in sustainable revenues and profits. Our disciplined approach to spending has resulted in 10 consecutive quarters of revenue growth and 5 out of the 6 past quarters of positive EBITDA. We have a clean balance sheet. We took on some equity capital. We have positive cash flow, strong working capital position. We're looking at M&As, which we'll talk about in our strategic plan, but we don't overpay. We look at capital as very delicate. We watch dilution on a very daily basis, and we're focused on a strategic growth plan to drive our future profitability and revenues. I think that discipline has led us to have tremendous strong financial results. In 2020, we doubled our revenue from 19, and we're on a similar path to double it in 21. We've already achieved 57 million in our 6 months reporting, and adjusted EBITDA of 22 million. We improved our guidance from 100 million to 118 million, and we're projecting over 42 million in adjusted EBITDA for 2021. I think we've looked at the industry sector coming down, and we look at our stock over the first 9 months of the year. Our stock has had the highest increase year to date of any public cannabis company. This chart shows that, and we're up almost 300% this year. I think another aspect of the company is our leadership in operational management and controls. We have a proven track record of operation excellence. I think our managers every day focused on cost and efficiencies. That's led to the strong EBITDA margins we have. But more important, we're committed to to develop trusted quality products, which we work on every day. A lot of other MSOs are looking for volume. I think the culture at Marymed is to create craft cannabis at scale. We believe the cream will rise to the top, and we always want to be dedicated to the top quality. We do that through our tissue culture, our quality genetics and strains, but we put that into our brands and formulations to create our top selling brand products. And we know they're top seller because the customers and the statistics prove it. I think more importantly, we continue to develop a company where culture is focused on collaboration, inclusion, social justice. I think when you come to any of the Marymed facilities, you'll see a happy group of people all working to the similar cause to create shareholder value for our stockholders. I'm going to fly through it. We have a national footprint, and anyone, if they have specific details, can come back. But we're in attractive, robust states and growing within that in our strategic plan, which I'll get to in a second. Obviously, I talk about the best-in-class cultivation. Our Nature's Heritage brand is the top seller in all the markets that we are in. Retail, we excel at. It's important not only to have the best products, but I think education, training of our bud tenders and people, and making sure that the customers have a tremendous experience. The new adapters that walk in there need to know how to get relief from cannabis, and we train our people to make sure that they get all the education and knowledge they need. A picture of our brands. Obviously, we have retail brands, product brands, and we're in innovation and science. Our Betty's Eddies, Nature's Heritage are top. We're looking at new types of seizing new categories with energy powder drinks. And this fall, we're coming out with infused ice cream here in Massachusetts. I think I would be resident in not talking about the culture. Every day we want to improve the lives of everyone, and our mission is to help them through the use of cannabis in our project, our products. In every location that we're at, we support local education and diversity, inclusion, and all the things through promotions, through sponsoring events, and for doing whatever that makes sense in the local communities. We need this on a national level. And I think diversity inclusion is going to be a major factor. And we asked ourselves and all the other MSOs spend a lot of time supporting this. Okay, so how are we doing time? Good. Strategic growth plan and drivers. Obviously, we're on a roll. We're debt free, as I've said, and we have a $46 million capital infusion from an equity firm that believed that Marymed was the next platform for an MSO to grow. So we recently acquired and rolled up 2 of our 5 states, Massachusetts and Illinois. That led to our transformational year and revenue in 2020 and now into 2021. We're in the process of consolidating the other 3 states where we built these businesses from the ground up organically, and we hope in the near future to be announcing the roll-up of that so that we could utilize the cannabis revenue into our financial reporting. Also, our second driver is to increase the revenue in the existing states. With our capital, we're expanding with new capacity for cultivation, adding dispensaries, and expanding in all the states that we operate. Our third driver, obviously, is to add additional states with a roll in our stock, our positive cash flow. We're looking to expand into other markets, either through M&A, looking for small SSOs of operators that share our vision, our values, and want to be part of a bigger organization that brings best practices to them. And we're also looking at new applications in states like Connecticut, New York, New Jersey, and others. Our fourth driver will be to continue to expand our brands and portfolios. We've just added a fractional CMO from Boston Beverage. We're rethinking our branding, our strategy, and we're looking to expand this into other legal states, either through licensing or through buying, production, and distribution in each of those markets. This slide shows the potential that we can organically grow from just 2 of our drivers, that we can add to our guidance of 118 million, somewhere between 120 and 210 million dollars, just from growing organically within. Obviously, the additional states and the additional licensing will take us to another higher level. So Summary: strong balance sheet, great footprint in attractive markets, cost efficient, dedicated to craft cultivation to drive margins. We have award-winning brands. We have validated, experienced management team, and we have a strategic growth plan that we're executing on all cylinders as I speak. So we're hitting it out of the park. We're poised for growth. And I guess we're out here talking because one of our frustrations has been that we haven't got the message. So we're talking to banks and to analysts now to get the message out here that we believe that we're a significantly discounted stock price compared to other MSOs. This chart basically shows that if we got the average percentage with a revenue multiple, our dollar plus or minus dollar stock today would be twice what it is in the marketplace. So I'm thankful to be here, and I'm anxious to answer any questions.
Thank you so much for that presentation and overview, Bob. We really do appreciate it. First question here from myself. Would you be able to discuss the M&A strategy from a holistic perspective? And maybe in doing so, would you be able to touch on how you're able to find accretive deals, even though the share price and the multiple where you trade at today might not necessarily be where is reasonable?
Yeah, I mean, we obviously we never went out and raised $100 million with a registered offering. So right now, with cash in the bank and adding to that with our positive cash flow, we're in a position we're looking for partners. So we look into a state, whether it's Michigan, or Ohio, or Missouri. We are on the map to look for people that will, if they want a good price from us, they're willing to take it over some terms and want to be part of a bigger organization. We think that our stock being low is a very attractive thing for potential partners or sellers, in that they can make more money from the appreciation of our stock as they can from the cash and the stock we give them in an acquisition. I think there's states coming up for new applications. We have great application writers. We've won 17 or more licenses in multiple states. We look to partner in those states with teams of people that show diversity and local support. And we're looking to be successful in M&A by strategic acquisition and or new applications.
Thank you for that, Bob. Plan. You lost audio. There you go. You laid out a aggressive strategic growth plan, driven by the consolidation of your businesses and deepening your presence in your existing states. Can you tell us if you'll need to raise capital to fund these growth initiatives, or is your operating cash flow enough to carry you over that hurdle?
Well, the good news is that we've the $46 million that we took in equity, we have $23 million in reserve to roll up a few targeted states in the bank. So the answer is no. We used the first $23 million to pay off all our debt, but we've already funded all our cap requirements of the in present and those going right through 2021. So we can execute our plan and get to this $300+ million without any additional need of capital. That being said, we need more liquidity in our stock. We're considering dual listing on Canada because we don't see Washington happening that fast. We need more stockholders. If we came up with an M&A that needed something, a lot of capital, I think with our track record, with our management team, we could do a registration and raise sufficient new capital to suit anything that we feel is strategically important to us and our shareholders.
That's very helpful. Could you perhaps elaborate on that comment you made on exploring a potential dual listing and how that could potentially help your existing shareholders?
Sure. The OTC has been great for us, but some of the bigger banks and analysts think that the Canadian Stock Exchange is where you need to be with more institutional people that can play in that exchange, even if they're US assets. So our initial plan would be to do a non-funding filing so that we could be dual listed on that exchange. And then if we need to raise capital, we'll still do it within the SEC and our filings here in the US. But yeah, we need more stockholders. We need to get more liquidity. We need more activity in our stock. We need to tell the world that we're not, as we were, just a consulting company with our revenue from rents and management fees and licensing fees. But right now we are rolling up to be a fully seed to sale MSO with the best products and the best team, and really the most consistent track record of revenue and earnings, as good as anyone in the industry. We're not the biggest anymore, but we're going to get larger, and we're going to do it in a disciplined approach and continue to work within our guidelines. And I think we're adding to our bench all the time. We've just added a new communication officer, a new investment relations officer. We're adding a CMO, and we're looking to others. We want to know that the entrepreneurs that took this business to 100, 200 million need to bring in some real professionals to take it to the $1 billion and beyond. So we're here, and we're very excited, and we love to tell our story, and we're really proud of the results and the performance that we've been doing.
Appreciate you providing some additional color on that. I wanted to ask about one of the slides in your presentation. You had a slide showing, how there was revenue potential above and beyond, what was implicit in your guidance. Could you maybe speak to what are the opportunities within your existing states and the existing portfolio to drive improved revenues? What are the low hanging fruits for growth above what you have projected?
So obviously in Massachusetts, we've only have one dispensary. We're entitled to 3. We're in the process, and hopefully we'll announce shortly the development of 2 others. Also in Massachusetts, we own a building that's 140,000 square feet. The tenant, we're in half of it. So we are basically, when the tenant leaves, we're going to double, if not triple, our canopy and our kitchens and production facilities to put more of our award-winning products into the robust Massachusetts market. In Maryland, we developed a 180,000-foot building. We developed 100,000. We're in the process of adding 80,000 square feet of new product development and canopy for more flower into a very robust Maryland medical-only market. Soon, I hope next year to be adult use as well. In Delaware and in Maryland, we are adding a dispensary that we hope to open the beginning of first quarter in Annapolis, Maryland. In Delaware, we own 2 of the 5 licenses that are open in the state. We were the pilot program there for the state. We're now developing a 110,000-foot building to triple all of our production there in Maryland as it moves also into recreational, hopeful next year. In Illinois, we're killing it with 4 adult use dispensaries. We're negotiating with some of the lottery winners to add 2 craft licenses and 6 more dispensaries so we can go vertical in Illinois. And in Nevada, we're looking to go vertical as well with the cultivation license that we own. So within the existing states, we can have significant growth. And I think on the slide that you're looking at, the rest is when we consolidate Maryland, Delaware, and Nevada into the PubCo, the revenues from those states will now go to our top line, and that growth that you see in that slide will be added to our existing run rate, which now at guidance is 118 million. So, I mean, just from the slide, seeing 2 of our 4 drivers, we could easily be over 300 million through organically growing within the assets that we have without any need of additional capital.
Understood. That's helpful. Thank you, Bob. I had a question emailed to me from an audience member. There are a number of brands that Marymed has in the marketplace. Just want to get an understanding of what are some of the best performing brands within your product portfolio that you produce, and where are there opportunities to enhance or potentially expand the product offering?
Sure. I think our top, we start with our cultivation of our craft flowers. We use the best genetics. We've developed them over the 10 years. We put them under our brand Nature's Heritage, which is our flower concentrate brand. We can't grow it fast enough. It's top sellers in most of the dispensaries as well as our own. And we're looking to expand that now into Delaware and other states. On the infused edible side, Betty's Eddies and Confusion have been superior brands wherever we develop them. Betty's has won national and local awards. We just won another one as the top, one of the top consumer products in the state of Massachusetts. With Robert Hall coming over from Boston Beverage, we're looking at our revamping our marketing. We're looking, instead of having multiple brands, but maybe get to limited brands and go deeper with SKUs and different kinds of products within it. As I said previously, we're adding new hot categories such as powdered energy drinks to compete with the new THC infused seltzers. Moving all that water is a challenge in the cannabis world. And with limited vault space in dispensaries, we're looking for an alternative that will achieve the same results. And we just partnered with Emac and Bolio, a old line Boston hippie ice cream. And we're coming out with a new infused ice cream, vegan, healthy ice cream. There is such a thing. And we're looking to do that by the end of the year.
That's excellent. Final question that we likely have time for. With so many MSOs to consider, could you summarize or give us the elevator pitch on why they should invest in Marymed?
Well, last question. I want to thank you, Andrew, for the opportunity. As we run out of time, we believe that we have the best practices. We have a validated team. We have validated products that are trusted by the consumers. We're a company that believes in strong financial disciplines. Our margins, our operating profits, and our SG&A and our models are tops in the industry. We don't overspend. We put our thoughts into continuing to share our mission and our values in the products that we do. And we're looking to replicate and scale what we do in these 5 states into multiple states across the country. So if we continue to increase our revenue and our margins and our EBITDA, we hope that that will be reflected in a higher share price for our investors.
Great. Thank you so much, Bob, for joining us today. I appreciate you taking the time to present the Marymed story and fielding questions from myself and the audience. We appreciate your insights into the business. And with that, I believe we're going to move on to our next presenter.
Thank you.
And we just got to reload the new slides up on the screen here. Just give us a moment as we get sorted out. We got a brand new, fresh off the print deck for us all to enjoy. And I'd be happy to get started with my intro. So first off, I'm pleased to introduce our final presenter for the day, Dan Neville, Chief Financial Officer at Ascend Wellness. Ascend shares are traded on under the ticker symbol AAHW on both the Canadian Securities Exchange as well as the OTC Exchange in the US. Ascend Wellness Holdings is a vertically integrated operator with assets and partners in Illinois, Michigan, Ohio, Massachusetts, and New Jersey. Ascend owns and operates state-of-the-art cultivation facilities, growing award-winning strains, and producing a curated selection of products. We have been impressed by the remarkable productivity of the company's retail store locations, which produce some of the highest sales per store metrics of any US cannabis operator. Ascend is also one of the most recent companies to list on the public markets, offering a fresh opportunity for US cannabis investors. With that, I would like to turn the call over to Dan to walk us through Ascend Wellness and its story. Dan, over to you.
Hey all, I can't hear audio, I don't believe. Andrew, can you hear me?
We can, yep, we can hear you.
Okay. I am just gonna go then, and then we'll figure out Q&A as we go, I guess. Great. Rebecca, could you just move on to the overview slide, please? Okay. So my name is Dan Neville. I'm the CFO of Ascend Wellness. I've been with the company for 2.5 years. I joined in May of 2019. Prior to Ascend, I come from a traditional finance background. So I worked in investment banking, worked at a New York-based hedge fund for about 10 years before joining up with Ascend, originally as VP of Finance and then moving into the CFO role last August as we look to move towards our IPO. This slide provides you with a brief overview of our company overall before I dive into the investment thesis and update everyone on the progress that we've made to date. So Ascend Wellness is a vertically integrated operator with assets in Illinois, Mass, Michigan, Ohio, New Jersey, and most recently New York. We've got an enterprise value of approximately $2 billion based on 2022 analyst estimates of $630 million and 2022 adjusted Ebitda estimates of $220 million. We're trading at about 7 times 2022 Ebitda. That 2022 Ebitda would represent approximately a 35% margin. Today, we're sitting at about a mid-20s margin, so we have a significant amount of margin expansion opportunity ahead of us, given that we haven't turned on our entire portfolio of assets. We have a strong balance sheet. We ended the quarter with $104 million of cash, and subsequent to the quarter end, we entered into a $210 million term loan with a 4-year maturity and a 9.5% interest rate. This term loan also has an expansion feature, which will enable us to pursue additional M&A going forward. A portion of this financing was used to repay our existing debt and refinance at a significantly lower interest rate. Prior to this financing, we had a weighted average interest rate of around 15%. We brought that cost of capital down to 9.5% through this financing. The proceeds, as I mentioned, will be used to repay our existing debt, as well as acquire MedMen New York and pursue additional acquisition and growth opportunities for the company. We're very excited about this financing as it brought down our cost of capital and represents a very good outcome that we were able to achieve as a newly public company. So this slide provides you an overview of the Ascend Wellness investment thesis. We call ourselves MSO 2.0 because we're a company that didn't pursue a strategy of state applications, but rather we went out and actively bought a portfolio of what we believe to be the best assets in the industry. We're now focused on building and scaling out these attractive assets with the intent to achieve scale in each of our markets before expanding and looking at new opportunities. Within these markets, we're focused on flagship locations. As competition enters the business, we believe in the value of superior retail locations. Like any other retail industry, will create long-term barriers to entry and will create value over time. We also have a very disciplined capital allocation program. Both Abner and myself were in your shoes. We were in the buy side, so we know the value of actively allocating our capital to the best return on capital opportunities that we see out there. The bulk of our expansion has been fully funded through sale leasebacks as well as debt and equity capital raised, and we're not biting off more than we can chew and are very diligent about where we spend our money. We've successfully grown our portfolio through M&A, and we see this as the fastest path to growth given the barriers to entry and the regulatory environment that's inherent in this industry. The company, as I mentioned, has room for further margin expansion over time, as only approximately 30% of our cultivation assets are generating revenue today. These are just a handful of reasons why we're confident that Ascend is positioned to succeed. The next slide provides an overview of our state footprint. We're primarily focused on flagship assets in limited license states east of the Rockies. We aim to have the best retail locations and have carefully curated our selection of assets. We've continued our strong growth and currently have 18 dispensaries open and 90,000 square feet of canopy operational today, with a robust pipeline coming on over the course of this year and into next year. Including the dispensaries that are set to open and our cultivation expansions planned, we expect to have 26 dispensaries and 285,000 square feet of canopy online by the end of next year. This represents our fully licensed, fully financed, and in development pipeline, and doesn't include any additional assets that we would acquire or future cultivation expansions beyond the phases that we have planned and financed today. We're pleased to develop such a robust pipeline in just 3 short years, with the company being founded in May of 2018. Next slide. Including New York, we're in 5 of the top 9 recreational markets and 1 of the top 3 medical use markets. We've ranked these assets in these states based on 2020 market size for both the legal and illicit use market, assuming that over time, the majority of illicit use will transition to legal. What's even more important than population and market size is the population per number of dispensaries. Based on the current footprint, our current footprint in this chart, it shows you why we're so excited about our opportunities in New Jersey and New York, as well as Massachusetts, combined with our continued success in Illinois. This slide also shows why Michigan is such a challenging market, given a very robust number of dispensaries within the state, with only 22,000 people per dispensary. We believe that by grading by population per dispensary, we can drive long-term value instead of focusing on short-term accretion within markets that may decline over time, which we do not believe is necessarily correlated to long-term value creation. Next slide. This slide provides an overview of our flagship locations throughout our footprint. We believe that we have the top locations in each state, and that these top locations in each state will have significantly higher revenue than other B or B- locations, just like any other industry. While Ascend is under 3 years old, we believe we've acquired some of the best licenses and the best local real estate in each of our markets. The top 20% of locations in the industry will generate 3 times the volume of just your average location. And we're seeing this today in Illinois. In the top left corner of the slide, you'll see our Collinsville store in the St. Louis area. This store does $50 million in revenue, which is multiples of the average dispensary in the state of Illinois. We also recently opened the first recreational location in a downtown city in the East Coast with our flagship in downtown Boston. That's the third picture to the right. This has been 2 years in the making, and we went the hard route going after a marquee location that's right next to TD Garden and right down the street from Faneuil Hall. But we believe, again, that assets like this are unique and will protect long-term value creation over time. On the right-hand side of the slide, you'll see 2 of our locations in New Jersey. The first is our Paramus area location in Rochelle Park, which is a half mile from the Garden State Plaza on New Jersey 17 with 100,000 cars going by a day. And the second location is a location in Fort Lee, New Jersey, that's right across the GW Bridge. This location is being built out today in advance of the start of recreational sales in 2022. We believe that these locations will do significant numbers in the 2022 timeframe when New Jersey transitions over to rec. And we believe these are 2 of the highest trafficked, highest density locations in all of the state. Next slide. This provides an overview of our pipeline of assets. So far this year, we bought on 5 dispensaries, and we plan to open 4 more by the end of the year. We anticipate closing the MedMen New York transaction by year end, which will provide us entry into the New York market. MedMen has 4 operating retail locations across the state, which are currently in New York's medical program, including the flagship location located on 5th Avenue, just steps from Bryant Park. I will also note that our canopy expansions that we're anticipating and we'll go over in the next slide are expansions of existing cultivation sites. We believe that canopy expansions at existing sites are significantly less risky and have less execution and timing risk than greenfield projects from scratch. This should give you confidence in our pipeline and the timing of our assets being brought online, as cultivation expansions are the hardest asset to bring online relative to retail and have the most variability and risk relative to time. So this slide provides an overview of our construction progress at our grow facilities. We currently have canopy expansions underway in Illinois, Mass, New Jersey, and Michigan, and expect to have 235,000 square feet of canopy online by the end of 2021. The first picture in the top left is a drone image of our Marquee, Illinois cultivation facility, which provides us with significant scale to our vertical operation in the state of Illinois. And we are one of the top wholesalers in the state. We currently have 55,000 square feet of canopy in Illinois today in the indoor facility to the left. And as you'll see on the right, we're adding 58,000 square feet of greenhouse capacity that'll come online by the end of the year in our fully sealed greenhouse. I like this picture because it illustrates the scale of our cultivation operations, as well as the speed at which we move to market. when we took over this asset in January of 2019, we had a shell that was somewhat warm with a de minimis amount of canopy. We aggressively expanded our canopy ahead of recreational sales to achieve scale into a recreational market and be able to supply our existing dispensary locations within the state when others were struggling with supply. Now we have a fully built out canopy, manufacturing, distribution center, and another canopy expansion underway. Our Illinois facility is the blueprint for our cultivation expansions across the rest of our states. The next image on the top right is a picture of plants being planted in the first phase of our expansion in our New Jersey cultivation facility. Around year end, we expect to have a second phase of the New Jersey expansion complete with additional canopy and processing capabilities. The first phase of expansion pictured here was started in April of this year, and we already have plants within it. This shows our ability to move at lightning speed to take advantage of new adult use markets. And we'll use the same playbook that we used in Illinois, in New Jersey, and other near-term recreational states. The image on the bottom left is a new flower room we recently added to our Massachusetts cultivation site. We'll be bringing on an additional 37,000 square feet of canopy by the end of the year, bringing our total canopy at this site to 54,000 square feet. This expansion is in the final stages of construction. Lights and tables are being added, and we expect it to be online by the end of the year. Next slide. We also continue to build out our portfolio of brands. We have 2 in-house ozone brands. Our core ozone brand competes in the quality for value segment, and our other higher end brand, Ozone Reserve, competes in the better category. We also look to partner with West Coast brands to increase our product offering in the best category. As you'll see in the chart on the right, our ozone brand brought in the second highest sales of any brand in the state of Illinois, including other notable brands like Rhythm, Verano, and High Supply, among others. The brand is developing a strong reputation in the market, and we're also continuously working to diversify our ozone offering to provide more form factors to our customers. It's in our strategy to deliver to every dispensary within the state of Illinois every week a full assortment of products, and we believe this distribution strategy is a key part of our success. A lot of people talk about brands and brand proposition, and that all will matter in time. But today it's really about getting a full assortment of products on customer shelves, delivering that consistently on a week in, week out basis to be able to present your value proposition to the customers consistently. Our brand partnerships provide Ascend with a unique opportunity to expand high-end product categories and provide each of our stores with a variety of different SKUs and form factors, as well as consistent access to differentiated product. Our differentiated brands combined with our consumer-focused retail experience is paying off. Our stores are some of the top stores in the state and are optimized to have fast throughput, multiple points of sale, and efficient layouts. We also have an exceptional digital experience, providing customers with access to express pickup, online ordering, and curbside options to consume. We want to meet our customers where they want to shop and deliver our proposition to them however and whenever they want to shop. Next slide. Both Abner and myself come from financial backgrounds. As I mentioned, we were once in your shoes, and therefore we're extremely judicious in how we allocate capital. We're acutely focused on return on invested capital and know that for every dollar we invest, we want to make sure it's worth diluting our ownership in our existing portfolio of superior assets. We have a disciplined two-prong M&A strategy. The first, in keeping with our strategy of going deep, not wide, is to continue to expand and look to achieve greater scale and optimize our existing footprint. While we have reached the regulatory cap in most of our states, we still have room to expand in Illinois with 8 retail licenses today in a state with a 10 cap. We're also committed to being a leader in Ohio. We have two dispensaries under agreement today and would look to expand in Ohio until we get to the 5 dispensary cap. In addition, we're committed to becoming a market leader in Massachusetts. And while we have a good start with the expansion of our cultivation facility, we'd be open to the possibility of expanding our cultivation, manufacturing, and distribution capabilities within the state. The second prong of our M&A strategy is to expand in other adult use or near-term adult use markets in states in the northeastern US. While we would focus on contiguous states east of the Rockies, we'd be open to opportunities in other limited license states. And one state that comes immediately to mind would be Arizona. At Ascend, we're opportunistic buyers. And if nothing meets our acquisition criteria, we're comfortable with our current portfolio. We're proud of our Q2 revenue quarter-on-quarter growth coming in above expectations. And as a result, we were able to increase our full year 2021 revenue guidance to a new range of $330 to $350 million of net revenue. This new range implies revenue growth of approximately 130 to 145% growth year on year. We have line of sight into this new range as all of the assets required to achieve this revenue are already turned on. While our revenue growth is impressive and our adjusted EBITDA dollar growth for the remainder of the year will follow, we don't expect to have significant, we expect to temper our quarter-on-quarter growth sequentially going forward, as we mentioned on the Q2 call. We grew at 26% quarter-on-quarter in Q2, and while we expect to maintain a robust clip of quarter-on-quarter growth, at a certain point, you're running into the law of at least larger numbers. We have canopy expansions underway in Illinois, Mass, New Jersey, and Michigan, and expect to have 235,000 square feet of canopy online by the end of 2021. These expansions will drive the next step function revenue increase, with them coming online at the end of the year, but not impacting results until early 2022 when harvests come down. With that, I'd just like to go over the final value proposition of Ascend and the overall investment thesis. As I mentioned previously, we call ourselves MSO 2.0 because we believe we are a company that didn't pursue a strategy of state applications, but rather went out and bought the best assets and took advantage of the best opportunities that the market afforded. And we're now focused on building out and scaling those assets. Within these assets, we're focused on premier assets in our flagship locations. And we have a very disciplined capital allocation program. I'd be remiss if I didn't mention the management team, which we've continued to build out, and we believe we have the team in place today to achieve this aggressive ramp. We have a variety of experience with folks from capital markets, real estate and permitting, licensing, traditional retail, as well as traditional CPG backgrounds within the company, layered on with robust experience operating in a cannabis market. The company has room for continued margin expansion and will continue to march toward our peer average peer averages, which range from 35 to 45% as we turn on the remainder of our portfolio. These are just a handful of reasons why we're confident as Ascend is positioned to succeed. With that, I will try to open it up to questions. I can certainly answer questions over chat.
Great. So how this is going to work, I will pose questions to Dan over
Let's
the
see.
Q&A feature.
So what are the key factors to providing a highly productive store network?
He's got it.
I'd say one of the things is just optimizing our stores for high throughput. When we started out recreational day one of sales in Collinsville, we had a line 6 hours long. And now that didn't obviously last forever. There was still significant lines early on in recreational sales as we looked to handle a tidal wave of volume and demand from our customers. And so what did we do? We had 13 POSs operating then. We jammed another 5 POSs into our Collinsville location. We implemented an online and reserve ahead ordering program. And by April of 2020, which also coincidentally we had to adjust for COVID, we were down to wait times of 10 to 15 minutes. I can't tell you how great it is for customers to know that when they come to an Ascend location, we will have the product available that what they want. We have a quick, easy online ordering reserve ahead experience that functions well, and they can get in and get out in 10 minutes. So I think that's one part of the key value proposition. And I think it's worth mentioning that we have always built our stores and built this company with recreational sales in mind. So typically when we do a build out, we're looking to have 12 to 18 POSs in a store. Our Rochelle Park location, despite doing smaller volumes today as a medical store, has 18 POSs within the footprint, and we have the ability to add 5 more. So while the volume isn't there today, we are positioned to service what we expect to be robust volume as recreational sales come online. I think other operators within the market may be challenged on medical to adult use transitions. They're operating out of medical stores with maybe 2,000 square foot of space. They maybe only have 4 POSs today. Maybe they can add, an additional 4 POSs. And a medical experience is also a very high touch experience. And so we found even internally, if you have a GM that is used to running a medical store, it's a big step up and big transition to move to rec. We have built the company for rec, and I think that allows us to take advantage and provide a very good, quick, efficient, but also informative experience to our customers. Next question. How is Ascend prioritizing between the opportunity of existing markets compared to entering new states? This is a great question. It's something we think about a lot. We've got some great opportunities for new states. Every acquisition that we look at, we've got to compare putting $1 to work in that acquisition versus putting another $1 to work in the great markets that we have coming online that are near-term rec markets in New Jersey and New York. So we have looked to fund our expansions, our expansions in New Jersey and in the future in New York, our cultivation expansions through sale leasebacks. Cultivation expansions are incredibly capital intensive. It requires a lot of time, money, and effort to put on those cultivation expansions. And we view sale leasebacks as an efficient way to achieve scale in our canopy in those markets. that strategy has allowed us to free up additional capital for M&A to go after new states. So we're taking a balanced approach, and I think any of the opportunities that we look at on the acquisition front, one, have to be right down the middle of the fairway in terms of our investment strategy, near-term limited license states, in near-term recreational markets, where we think we can achieve high returns on invested capital and be a top 5 player in that state. If we can't do that, we'll probably look to invest that capital in opportunities in New York, New Jersey, or go deeper in some of our existing markets like Illinois and Ohio. Next question and final question. Ascend operates in supply-constrained markets. How do you allocate between your own stores and wholesale opportunities within the state? So we pursued a strategy. We don't believe in the company store model. There are other companies that only want to run their own product through their own stores. We don't ever want a customer to leave an Ascend store because there's a product that they want and we're not carrying it because it's our own product. With that said, today about 35% of our sales within our stores are our own product. We do not have, fulsome product and production capabilities in each of the markets that we operate in. And we'd like to move to a 50-50, internal Ascend product, 50% external product over time. So that is the goal near term, to move to that model. Today we're at 35, we're moving towards 50. But we'd like to be a robust player in the wholesale market. We feel that there is value to extending our brands to the rest of the state, building up distribution capabilities, especially as markets become more supply constrained or less supply constrained, and building up wholesale relationships. So I don't think you'll ever see us move to the penetration of our own product that you see with some of our competitors at 65% plus. We think the company store model died with Sears and Kmart. Amazon and the internet brought consumers choice, and they're going to continue to want choice. And so we'll give them what they want.
Great. Thank you so much, Dan. We really appreciate your insights into Ascend today. And we thank you very much for joining us as well. So thank you, Dan, so much for being here.
Thank you.
Great. Well, this concludes our lineup of presenters today. We plan to post a video of each presentation on Echelon Wealth Partners YouTube channel over the coming days. So please keep an eye on our social media platforms. We would like to extend a thank you to all the presenters who took the time to share their insights on the exciting and fast-moving U.S. cannabis industry. We can clearly see that the momentum is behind the operations and the financial performance of these companies. And the recent share price performance has offered investors with an incredible investment opportunity. We heard from 5 of America's leading cannabis businesses that there's a long runway for growth ahead, and we look forward to participating as that unfolds. We'd also like to thank our clients and our audience for joining us on Zoom and on the YouTube live stream today. We hope you enjoyed the presentations. This concludes today's conference. Thank you very much for joining us, and you may now disconnect.